What if the silver market's recent steadiness is only a short-term trick based on a secret deal that ends in 3 months? There has been a whisper campaign going around saying that a huge, almost silent movement of metal has just happened. This was not a normal market deal. People think it's a lease or a very big, very short-term loan of silver moving from east to west. Reports say that things are very bad in London and that a Western gold bank, maybe even one as big as JP Morgan, is looking to China for help. The most likely counterparty is a Chinese banking giant like Industrial and Commercial Bank of China. The terms of this deal are what really puzzle me. It is said to be a huge amount, maybe 100 to 150 metric tons of silver. But the most important thing is that it will last for 3 months. The clock for 3 months has just begun to run. This timeline leads us straight, almost ominously, toward the end of December, or more likely, the beginning of January. When that date comes around, the metal must be sent back to China. This is not a nice ask. It's a hard duty under the contract. Whatever unstable balance has been reached in the silver market and whatever relief the LBMA is feeling right now may only last for a short time. As the new year starts, there may once again be a real lack of silver. We are really weak right now, so this short-term fix is very welcome. When you look at the gold and silver numbers, things don't look good. Early in the week, both metals lost a lot of value. Even though they may be taking a break, the damage is clear. Gold futures prices have dropped below $4,000 and cash prices are not far behind. Prospects for silver have dropped to $47 and spot is right behind it at $48. There was even a brief glimpse of going backwards, but that seems to have gone away for now. What do we think about this sudden change in price? On the comics, you can see the open interest statistics for both gold and silver. This will help you figure out what's going on. It's not about the exact numbers. In the past week, open interest has dropped sharply from its high point, even though it hasn't hit rock bottom yet. Prices for both metals are definitely going that way. And the key is this trend. When people see the price drop, a lot of them think that the gold banks have flooded the market with a huge number of new short positions to make the price go down. And yes, that may be part of the story, but the open interest data tells a more complex and different story. There is a paradox in every single open interest contract. There are two bets going on at the same time that the price will go up or down. Both the long and short positions are locked together, making it a great pair. So a drop in overall open interest doesn't just mean that more shorts are being added. This means that generally the number of long and short positions is going down. They're being shut out. Then what is really going on? And it looks like a planned rinse of the longs. The main people who were long were CTAS, commodity trading advisors, and managed money funds. These are the investors, funds, and even individuals who ride the wave, often with a lot of borrowed money. They saw that things were going up and jumped in. Then the COMEX market moved, and if I remember correctly, margin rules were raised, maybe even twice in the past month. This move is very common. The cost of cash for managed money funds and CTAs is high. A quick need for more margin can be very bad. They have to close their positions. If they can't get the extra money right away, they have to sell. This is the wash. On the other hand, gold banks can get money quickly and cheaply. They don't really notice the profit increases. They will be able to handle the storm they helped make. This process of getting rid of the controlled money and leveraged longs happens over and over again. Today there's a small bounce, but it feels weak. Gold might move back up to touch the $4,000 mark, but the big picture may be set for the next month. It's likely that the gold banks will keep putting pressure on the managed money and CTAS all the way through December, which is also a very important delivery month. And this move serves two purposes. It's not just about making money. The more banks can wash their controlled money, which forces them to sell, the more metal they might be able to get their hands on. And they need that metal very badly right now. They can send metal back to London. Has this ever not worked out for them? When you look back, you can see that the prices of gold and silver have been going up over time. But in these short-term fights, the controlled money and CTAS always lose when they get ahead of themselves, when they get too greedy, and when they take on too much debt. This trend has been going on for years. The gold banks have always been able to wash them out. But this makes me think of an interesting question. Why does the rest of the world want to help London so badly? The LBMA is in a lot of trouble. How does the rest of the world have the right to save it? Some even say that China, of all places, sent its own metal to help the London grid stay strong. What possible reason could they have to do that? The answer is just as smart. China does not want the LBMA to turn out badly. Not yet. That's what they do. In a very organized way, it works like a huge tube, pulling metal from the west out of vaults in the west and sending it eastward. If the LBMA completely fell apart, it would be terrible for them because that window of opportunity to buy things would close quickly. From this point of view, China's action wasn't a rescue. It was a well thought out plan to protect its own interests. They want the LBMA to stay alive so that it can keep being that funnel. This makes sense when Bloomberg says that China sent 100 to 150 metric tons of silver to save the LBMA. However, let us consider how that deal would have gone. This was not a disorganized rush. It's crazy to think that a Western bank, even a big one like JP Morgan, could just fly to China and start buying 150 metric tons of silver from hundreds of small-time metal dealers. Think about the logistical mess. You'd have to open every box, weigh each bar, and check the purity of a huge number of different goods from a huge number of different sources on such a short timeline. It's not possible to do it. No, this had to be a very important bank-to-bank deal. The most sensible way to get there is to go straight to ICBC, the Industrial Commercial Bank of China, or even the Bank of China. These aren't any banks. This group of big companies runs the vaults for gold and silver for the Shanghai Futures Exchange. A very important thing to note is that both ICBCB and JP Morgan are LBMA cleared members. They are on the same level. They work with people in the same groups. It makes a lot more sense to think that JP Morgan went to ICBC and that ICBC planned the whole shipment using its many resources. Once more, it wasn't a sale. Furthermore, China is also having a hard time with its own silver. Selling the metal wouldn't make sense. It was a lease. It's possible that the terms were very harsh. In the past few weeks, silver lease rates have gone through the roof. Reports say that rates sometimes hit 100% or even 200% per year. Let's play it safe and say that Western banks were pleading for money and the Chinese offered a 100% rate. That's a 30% return on the metal's face value for a 3-month loan. The Chinese are getting a great deal and they'll get their metal back at the end. They need that metal again. It is said that China's own free float silver stockpile, or the amount of metal that is available on the market, has dropped to about 1,000 metric tons. This is a record low. They've never been this low before. China is often a place where silver comes and goes, and it buys more than any other country. Things that come and leave. It's used for computer farms, solar panels, EVs, AI, semiconductors, and AI.